Thanks for clicking! All eyes were on Stats Canada this morning as it was set to release Canada's inflation data for the month of October, with most expecting a modest rise in inflation, something around 1.9, mostly on higher oil prices. We got our answer at 8:30 this morning when inflation came in a bit higher than that, coming in at 2%.
So what?
And while inflation coming in higher than expected is definitely not great news, I think the real news is, as we'll see, measures of core inflation showing signs of acceleration, especially given that those measures strip out more volatile items like food and gas. And while the Bank of Canada is probably still going to cut rates at its next announcement in December, the acceleration comes as inflationary pressures are continuing to grow, mainly stemming from, as we'll see, the currency markets. So what I want to do today is go over Canada's inflation data for the month of October, take a look at some of these inflationary pressures that we're seeing, and we're even starting to see them show up in prices, and then discuss some implications. As we'll see today, Canada's economic development remains uncertain, but we will obviously continue to track it on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this inflation data. Onto the data. As mentioned, Canada's inflation rate came in at 2% in October, slightly higher than economists were expecting.
Nothing's changed.
Major upward contributors to the inflation rate were mortgage interest costs, rent, car insurance, food from restaurants, and property taxes, while major downward contributors, those prices pulling down the rate of inflation, were gas, phone, travel, air transportation, and traveler accommodation. So, as long as you leave the country and take your phone with you, you're all set.
Pack your things, friend.
Okay.
Further, and this is going to be extremely important later when we discuss upward pressures on prices coming from the currency, prices for food from the grocery store also rose at a faster pace. In measures of core inflation, those measures that the Bank of Canada looks to when deciding whether or not to raise or cut rates, and those measures which strip out more volatile items like food and gas, also increased, with CPI median increasing from 2.3 to 2.5 and CPI trim going from 2.4 to 2.6. And while that 2.5 and 2.6 is a year-over-year stat, which sometimes can hide the true underlying price pressures, if we look at the month-over-month stats, they're not that great either, with both CPI trim and CPI median accelerating on a month-over-month basis. So, headline inflation coming in at 2%, higher than the 1.9 that was expected, definitely higher than last month's 1.6, and we are seeing a bit of acceleration in measures of core inflation. And I think some of this extra inflationary pressure could be stemming from the currency markets, as the Canadian dollar continues to fall relative to our southern peer. And it's not just that the Canadian dollar is weakening, the US dollar is also strengthening. If we look at the DXY, which measures how strong the US dollar is relative to a basket of 6 other currencies, we can see that it's up almost 7% in just over a month or so. 7% increase in just 1 month? That's big for a currency. And the growing spread between the value of the Canadian dollar and that of the US dollar means that everything we import is going to be getting more expensive. Martin Eichenbaum, economics professor at Northwestern, said that this differential will show up as inflation in Canada. And this isn't just theoretical. It's not just a bunch of academics talking shop. It's real, and it's starting to show up in some of the local grocery stores. CTV News spoke to a grocery store owner in Ottawa this week who said that extra exchange rate gets added to not only the price of food but also to freight, and by the time the customer sees it, the difference is quite big. And yeah, that's what we were talking about earlier when the CPI is already seeing some acceleration in the price of food from stores. And the owner summarized, you walked in a few weeks ago, the lettuce was $1.99, now it's like $3.99. Same thing with broccoli, the celery, all the way down the line.
I hadn't noticed.
So yeah, weaker currency, any food we import from the United States is going to cost more money. But it's not just food. Canada imports over $250 billion worth of goods from the United States per year, so you can imagine a 3 or 4% swing in the value of our currency can and will show up in prices. Which begs the question, what exactly is going on? Well, the first is the phenomenon we've been talking about over the past year or so, which is the Canadian dollar weakening against that of the United States, which is not expected to change anytime soon. And the reason? The divergent policy rates, the divergent interest rates between the Bank of Canada and the Federal Reserve. with Canada's policy rate sitting at 3.75 and the Fed sitting right around 4.5%. When the Fed's rate is higher, that makes it much more lucrative to loan money to the United States. As such, if you want to loan the United States money and cash in on that higher interest rate, then you need a US dollar. Therefore, demand for US dollar goes up, and relative demand for that of, say, the Canadian dollar goes down, putting downward pressure on the value of the Canadian currency. Just take a look at the markets. Right now, you can loan the US money for 4.3% yield, or you can loan it to Canada for about 3.16. Clearly, if you want to invest in the bond market, you're going to want to get yourself some US dollars, as there's more money to be earned lending it to the United States. And, for now at least, it doesn't look like this phenomenon is going to be changing anytime soon, as hotter than expected economic data coming out of the US has the Fed hinting that it may slow down on the rate cuts. Meanwhile, the big banks are predicting that the Bank of Canada could cut by another 150 basis points or more.
Way more.
So, on the one hand, we have the Bank of Canada set to cut in order to stimulate the economy, and on the other hand, we have the Federal Reserve slowing down the cuts as the US economy is already pretty hot. Two very distinct, divergent economic trajectories. But there is another part of this story, not only the weakening of the Canadian dollar, but also the strengthening of the United States dollar. And as to why, well, it's the Trump trade. As we've discussed before on this channel, newly elected President Donald Trump plans to run the economy hot, cutting taxes and deficit spending. As such, if you want access to that hot economy, if you want access to the US stock market, you need dollars. And again, more demand for dollars increases their price. Further, according to Goldman Sachs and a host of other economists, tariffs increase demand for dollars as well. If the US erects those tariffs and isn't going to be importing as much as it once did, then that means that there will be less dollars heading out into the global economy. Therefore, the global economy, China, Canada, Europe, etc., won't have as many dollars available to them if they want to invest in the United States economy. Further, very briefly, while on this note, there is actually a global debt angle to this story as well, though it's definitely far beyond the scope of this video. I do have an interview coming out with Dr. Michael Howell of Cross Border Capital, which goes over the global demand for dollars to repay debt. Now, right now, this dollar strength and the price pressures being put on the Canadian economy is in the short to medium term. In the long term, some are arguing that these tariffs could in fact weaken the United States economy, putting downward pressure on the dollar, but for now, the so-called Trump trade is increasing demand for dollars, which is increasing the price of Canadian imports, pushing up our inflation. And this is a potential problem that we've been talking about so much on this channel for the past year and a half. If the Canadian economy continues to weaken and the Bank of Canada needs to cut rates in order to bump up employment, in order to stimulate the economy, but at the same time we're seeing inflationary pressures coming from geopolitical forces, coming from the United States, then that puts the Bank of Canada in quite the bind. My guess is the Bank of Canada, even with this hotter than expected inflation data, will still be cutting rates in December, as I think a weakening economy heading into the mortgage renewal wave is scaring the heck out of them, but I think they'll be a bit conflicted about doing so. Further, should these pressures persist, I think the bank is going to have a difficult time justifying those 150 basis points worth of cuts if inflation is re-accelerating once again. With that said, so much of this is unknown. That Trump trade could unwind very quickly as we start to understand how Trump will act once in office, which policies will be implemented, and that 7% increase in the value of the dollar very well could be short-lived or could go higher. The currency markets very rarely move in a straight line. A 7% increase in 1 month probably is not sustainable. With that said, we will continue to track Canada's economy, its inflation rate, and those pressures coming out of the United States on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.